Hello traders and happy Friday. Certainly if you're sitting in a camp where you're short risk assets in some sort of capacity, you're laughing the loudest at the moment, and certainly a trade that we've been warming to has been short oil. We're looking down at the 200-day moving average around 67.29. I think if we get a break of that level, which is a level that we tested back on the 16th of August, and we saw a nice rebound from there, but if we do get a break then subsequently, you were probably looking for the recent lows down in August lows down at 64.43 to come into play. That's the bottom end of the range. I think if we probably expect to see some buying kicking in around there, but if we do get a break of that 64.43 level, then I think you go much lower in terms of oil. We establish a new trading range coming through there. Definitely one that's been on my radar, and it's been a positive impact on dollar CAD, which is a trade that we put out yesterday as well. Certainly a trade that we've been focused on has been the Nasdaq. That trade we thought could potentially have a little bit more juice to the upside after a bullish move earlier in the week, but of course that hasn't been the case, and we've been stopped out of that idea. One of the key aspects that we talked about yesterday was some of the things that are bubbling around in the background, and we look to reduce risk given that the uncertainty was providing. So I'm happy with the process that we've developed here, which is managing risk accordingly, and that works out quite well. So in terms of how the process has gone, I'm fairly comfortable with what we've been seeing here. But I think the dark art of what's happening within quantitative tightening is something that's become very, very prevalent here. We have to be looking at the plumbing behind the financial system at the moment and seeing exactly what's happening. This is a complicated situation that a lot of people don't really have a firm grip on, and I'm not saying I'm an expert by any means, but I think if you have a look at what's causing the anxiety around here, it is reduced liquidity from financial markets. There has been a liquidity drain out of emerging markets for some time. We're seeing that in China at the moment. Chinese equity markets are down 30% from their highs. Considering that 80% of the daily turnover through the Shanghai Composite is retail, there has to be an impact on people's perception of their wealth effect. This feedback loop into the real economy has to be concerning the authorities there. If you look at real asset values, property prices have been getting absolutely destroyed. If you look at the Shanghai Property Index, it's in a beautiful downtrend at the moment. So those combinations there, if we mix in the weakness we've been seeing in the yuan, where we're looking for dollar CNH, the offshore renminbi, pushing up to the highest level since August, you've really got the holy trinity of concerns in China that there will be a feedback loop, and we probably may see that reflected in the data longer term, or we may not, depending on the situation. But there is a radical tightening of financial conditions, which will mean we're going to have a fiscal response from the government at some stage there. But if you have a look at the actual plumbing in the system, the cost for funding, and have a look at the LIBOR or the forward LIBOR relative to OIS, which is effectively the cost for interbank borrowing relative to the OIS market, the overnight index swap, which is reflective of where the Fed funds sits on different contracts and the expectations of future hikes. The wider that spread, effectively the deterioration in effectively the credit risk we're seeing there, and we're seeing that spread moving up quite sharply of late. So there's a funding issue that's coming through. The cost to effectively get funding from the banks is going up and up and up. And that's definitely something that we're keeping an eye on. We've seen the cost to get US dollar liquidity in this cross-currency basis swaps going up, and we've got wides against Japan and Euro as well. So for Japanese investors and for European investors trying to get hold of US dollar liquidity, it's pretty expensive at the moment, and that's also become a bit of an issue. And if you think that liquidity is effectively the lifeblood, it's the oxygen of financial markets. The less liquidity, the harder it is to get in and out of positions. Bid offer spreads widen, considering it's 80% or so of the daily turnover, perhaps even higher of the daily turnover on the S&P is done from systematic funds, from algorithmic trading. If the cost to trade is becoming ever more expensive, then of course you're going to see those guys reduce liquidity from there as well, and it's just going to exacerbate the problem. Have a look last night at euro dollar front month. If you have a look at that, over 1 million contracts were traded. So people have gone to cash. That's the biggest level or most volume coming through in euro dollar futures, the interest rate market that you can trade, since the Lehman Brothers collapse, effectively, or the second biggest move since the Lehman Brothers collapse. So there has been a vicious move out of or repricing through interest rate markets, and the markets are testing the Fed now. There has been a sharp tightening of financial conditions, not just because equity markets have been going lower, The real yields are staying firm, and of course we've seen interest rate markets pricing. So they're now having an effect that they're starting to price out rate hikes. When financial conditions are tightening so radically, the Fed don't need to move. The market's doing the job for them. So it's disincentivizing the Federal Reserve from raising rates at the December meeting, certainly from March. My view is that they'll still raise rates in December, but the probability here of a March hike is coming out of the market quite radically. So I think what we're seeing at the S&P, holding on to that 200-day moving average at the moment, we're just holding on to that 55-week moving average at 27.30, is you're seeing a funding issue, you're seeing a liquidity issue which is coming out of markets. It's hit the bond market, it's hit the rates market, equity markets will come out afterwards, and then we'll hit the real economy. That is the chain of command with liquidity. It's ultimately why we saw QE in the first place, was to pump the market full of liquidity, excess liquidity, which should have a benefit on the real economy. Now we're seeing the dark days of quantitative tightening impact, and you are seeing implied volatility pick up. So the idea here that we are seeing a funding issue, we're seeing a liquidity issue, we're seeing that in the funding markets, and it's resonating other asset classes, and it's something that we're just really, a lot of people don't have a firm understanding of, and it's something that we do need to get fully educated on, because it's what's caused the GFC. And I'm not saying it's going to cause this now, but we are seeing heightened volatility on the back of this at the moment in equity markets.